Cash is not the safest asset, it is the most certain to lose value. Holding cash is a zero-return, positive-risk investment because inflation erodes its purchasing power every year. Examines the historical evidence, the mechanics, and the strategic implications. Most people equate cash with safety. But safety should mean preserving purchasing power, not just nominal value. Cash in a savings account or under the mattress does not grow, it only waits. Meanwhile, the prices of goods and services rise over time, meaning the same amount of cash buys less. This is the money illusion. We focus on the face value of our cash, ignoring its real value. The real value is what matters for your wealth. The real return on cash is the nominal return minus inflation. For cash, the nominal return is often zero or near zero, so the real return is negative whenever inflation is positive. This simple formula explains why cash loses value in real terms. Since the collapse of the Bretton Woods system in 1971, the US dollar has lost about 81.4% of its purchasing power. This chart shows the decline in the value of a dollar over time, based on CPI data. The trend is clear: cash held for decades loses most of its value. The period from 2020 to 2023 saw the highest inflation in decades. Cumulative inflation over these 3 years was about 18%, meaning cash lost nearly a fifth of its purchasing power. This was not a normal period, it was a shock driven by pandemic stimulus and supply chain disruptions. But it illustrates how quickly cash can erode. The Fisher equation links nominal interest rates, real interest rates, and inflation. It shows that the real return on any asset, including cash, is the nominal rate minus expected inflation. When inflation expectations rise, the real return on cash falls, even if nominal rates stay the same. Compare cash with assets that protect against inflation, such as TIPS, Treasury inflation-protected securities, or real assets like gold. While cash has a negative real return, TIPS adjust for inflation and provide a positive real yield. This comparison shows why cash is not a good long-term store of value. This bar chart shows the real return on cash, using 3-month Treasury bills as a proxy, in selected years. In most years, the real return is negative, meaning cash loses purchasing power. Only in periods of very low inflation or high nominal rates does cash have a positive real return. During financial crises, cash is often considered safe, but it can be dangerous. After the 2008 Lehman collapse, central banks launched quantitative easing, which increased the money supply and led to inflation. Cash holders saw their purchasing power erode. Similarly, in 2020, the Fed's unlimited QE led to an estimated 1.4% loss in real purchasing power for cash holders within a year. The opportunity cost of holding cash is the return you forego by not investing in assets that appreciate. This cost is the difference between the expected return on investments and the return on cash. Over long periods, this difference compounds, making cash a costly choice. Cash does have a strategic role, it provides optionality. In a market crash, cash allows you to buy assets at depressed prices. This is the option value of cash. But this option is only valuable if you actually use it. Holding cash indefinitely without deploying it is not a strategy, it is a cost. The key is to balance the option value against the guaranteed loss from inflation. Cash is not a safe asset, it is a guaranteed loser in real terms. The evidence is clear: since 1971, the dollar has lost 81.4% of its value. In high inflation periods, cash loses quickly, and even in normal times, real returns are often negative. Cash has a role as a tactical tool for opportunities, but holding it as a long-term store of value is a mistake. Understand the real return, the opportunity cost, and the option value. Then decide how much cash you truly need. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.